Yes, friends. So we'll start with the new chapter, okay, which is your group audit, chapter number 13. First of all, to tell you, it's a very simple chapter, okay, and it is having the flavor of India's 110. Since you already know about 110 or consolidation, whether it's coming from accounting standard or India's, so it doesn't take time for you to understand this chapter, like what exactly they are trying to tell. Okay, and this is one of the specialization because today organization structures are becoming very complex. 250, 300 subsidiaries they will have, sub subsidiaries they will have. So consolidation in 1925 it started with the Noble Industries, okay, that Alfred Noble, who is on, okay, who created a dynamite. Now their company started to do the consolidation first time somewhere in 1925. So now after that, the people started to do, they started to understand the benefit of consolidation, like why it is required. Then it slowly started to evolve. Today it has become like a core specialization only, like how do you prepare the consolidated financials. Yes, so we will try to understand what they are trying to tell about the consolidation. So this group audit or a consolidation audit is the audit of your consolidated financial statements prepared as per your accounting standard or Ind AS. So we are going to come across some small concepts of SA 600 also, which we have already studied. Now, audit of CFS talks about the responsibility of preparation or by the CFS by the parent, when they have to make the CFS, what is the responsibility of an auditor, what is your considerations like permanent adjustments and current period adjustments, what representation, reporting and the using work by the other auditor. Now, CA Mudit is the auditor of the manufacturing company, and this company purchased the shares of another company in USA. Now, section 129 of the Companies Act, because this is a company, says that you have to prepare consolidated financial statements in case you have got subsidiaries or associates or joint venture. Now, whether the foreign subsidiary is also covered within the scope, yes, India's 110 talks about it. They provide more clarity as to how to do consolidation, when the exemptions are given. So there are different exemptions available. Now, Act also gives exemptions. India's also gives. Accounting standard also gives. So these are all the part of the basics. Now the management was caught in the dilemma because they have acquired all the shares. Okay, first thing, there was a confusion. Should we prepare CFS? The answer turned out to be yes. CFS has to be prepared. Second problem they got into, that they acquired the shares only in the month of June. Now they got a confusion. Should we prepare the consolidation from April or should prepare from June? Again, who will give you guidance? India's 110 tells that you should start consolidation from the date it is acquired. So, date of acquisition is very important because we come across the post-acquisition reserve, pre-acquisition reserve, calculation of the goodwill. Now, India's 110 says that from the date of when you have gained the control, you have to prepare the CFS. Now, while auditing such group, the CA discovered that the foreign subsidiary accounts were unaudited. See, one more problem came, problem after problem. Now, this has put them into catch 22 situation. Now, what exactly is catch 22? We will see. Now, what is its implication of unaudited financial statement? What should be my consideration? So, he is confused. The India tells you how to do accounting, but will it tell you how to do audit? Now, you may have come across different scenarios like this, like one of the subsidiaries sitting in foreign company, it has not been audited, or you are not the auditor of that subsidiary company. So there are so many issues you are going to have. Now, how you are going to address these issues? Who is going to guide you? You have got SA 600 tells what is your responsibility when it comes to the branch auditor or component auditor, subsidiary auditor. But what exactly the things you need to consider when you are doing group audit? Okay, let us see this chapter, what it is going to tell. Yes, so sorry, we'll continue. So what exactly is your catch 22? Why do we say catch 22 situation? Okay, so now catch 22 word has come from one novel written by Joseph Heller in 1961 called when the World War II was going on. So this theme of this movie, this novel is all about World War II. And there is one captain called John. He wants to escape from the dangerous combat. Now, what is that? He wanted to be alive. But the problem is, as per the military rule, he can be sent home if he is insane. Then only he cannot drive the, like he cannot have the flight. Otherwise, he has to prove that he is insane if he want to escape. However, if he wants to, he is trying to prove that he is insane, that itself shows that he is sane. Now, catch 22 is something, it is very difficult to do. It is contradicting. Okay, if you want to do one thing, the other thing should happen. Other thing should do, the first thing should happen. So it is more like a catch 22 where you are trapped into a problem and the conditions required to solve the problem make it very impossible to solve the problem. That's why they call it a catch 22. Now, what was that catch 22 problem here? First of all, see, if we what is the objective of the audit? You have to figure out there is no material misstatement. So you have to, how do you ensure that? You have to gather sufficient appropriate evidence. Now, if it was only parent, not an issue. You got a subsidiary which has not audited. So how do you get evidence about it? Now, can you get it audited? Because it is sitting in USA. Now, getting audit becomes very difficult. So what you do? You end up issuing disclaimer of opinion. So what standard says? You resign from the engagement. So should I resign? Should I continue? Should I end up giving disclaimer? So this becomes one catch-22 situation for audit. But after going through this chapter, that catch-22 situation should be very clear. You should be understanding like how to do such, attend such scenarios. Now, how this chapter is organized? We will see that, students, there are only 4 concepts here. Remember, only 4 concepts. Because any examination question comes, you have to catch the keyword. First, you need to figure out the chapter, and this chapter is chapter number 13. So, in chapter number 13, where exactly the question fits, there are 4 concepts you need to remember. Concept number 1, we have to talk about the basics of consolidation. Concept number 2, your audit considerations. Concept number 3, special consideration, which includes permanent adjustment and your current period adjustment. Concept number 4, reporting. So any question comes, first, okay, where exactly, which concept this will fall. Then sub-concepts will come into picture. So the first part is a very simple. That's why I told no, we need not spend time. We can quickly finish this chapter because you already know about this. Now, first they talk about the introduction, like consolidated financial statements are one where parents and subsidiaries financial statements are shown as a single entity. You don't know this, you know this. Already at the inter level you have done. Now they present the financial position of the entire group. Whenever they prepare balance sheet, P&L, it's for the entire group. Now why it is required? Because it's going to provide a complete overview of the operations and profitability of the group. Like for example, okay, we know that Tesla is the richest, Elon Musk is the richest person on the earth now. But how did, see, if you see that so many countries are there, around 50 countries are there. If we add the total GDP of those 50 countries, then you will match to one person's wealth. But when we get such an overview, okay, when we get that such a perspective, did this entire money came from one source for him? Is it Tesla only? No, he has got spaceship, X, and so many ventures are there. Now, when we say that he is the richest person, it is not just one entity making him the richest person on the earth. Say, like there are so many entities which will make him together the richest person on the earth. Now, we can get this overview only when we look at the CFS level, consolidated financial statement. Even I also did. See, when I look at my wealth from the consolidation level, okay, that gives me more comfort. Okay, it feels like, okay, Baba, it feels reasonable. But if I look at the standalone, I may not get that certain perspectives. Okay, so now what happens in a consolidated, you and your entities, subsidiaries and everything, why? Because ultimately they are going to help each other because all these people are within your circle. Now, when we look into the people within our circle and when we consolidate the wealth, we get more comfort because somewhere we are going to get that comfort itself is sufficient, that perspective itself is sufficient. Similarly, an organization, the investors will get a better understanding when you consolidate, and a lot of things you can eliminate, like intercompany transactions, some frauds and fraud type of things can get eliminated because at a standalone level you can be doing some fraud, but you will be easily caught at the CFS level. Now again, this introduction is not required for audit. This is already introduction for your FR or your accounting standard accounts. Now, what is you have got the financial statement of MNO, who is a parent. They have got subsidiary ABC and XYZ, and they prepare the group consolidated financial statement. for MNO, ABC and XYZ. So they have told here in the diagram, MNO is the parent having two subsidiaries. Now auditor of ABC and XYZ, auditor of MNO is SS Maheshwari. Now auditor of ABC and XYZ is RT Associates. Now if SS Maheshwari itself is the auditor of ABC and XYZ, then SA 600 is not applicable. SA 510, SA 710, these may not become applicable because you yourself is the auditor of that company. You are the last year auditor. Okay. But when the subsidiary auditors are different, SA 600 also becomes applicable. Now SS Maheshwari will act as the principal auditor. Now management of all the three companies are responsible for preparation of standalone financial. Okay. MNO's management board is responsible for MNO SFS. So there will be three SFS. Now the parent company, that means board of directors, already has got one more responsibility to prepare CFS, where they will consolidate all the groups based on certain accounting principles. Now we need to consider following points: the responsibility of the parent company, because when they become responsible to prepare, do they have any exemptions not to prepare? If they are going to prepare, what type of adjustments, which is permanent and current period adjustment, they need to make? Now, what is the responsibility of the principal auditor? How they need to coordinate between other auditors, and what is the reporting requirement under different scenarios, like where subsidiary is sitting in a foreign country, subsidiary was not audited, you are not the auditor of subsidiary. Okay, in different scenarios, how you need to report now? Okay, that's what we are going to cover in the rest of the chapter. So CFS is prepared in the same format the way parents' financial statements are prepared. So whichever accounting framework is applicable to the parent, the same framework will become applicable to the consolidated financials also. Now what should be the format? The format is same, Schedule 3. So whatever applicable to Schedule 3 balance sheet format, P&L format, same thing becomes applicable. So they have to prepare CF consolidated balance sheet, P&L account, cash flow, changes in the equity and all notes to accounts. So this becomes one complete set of financial statement. Now one question comes, sir, when we are going to prepare the notes to accounts, are we supposed to see, because what happened when we are preparing the notes to accounts as per SFS, we give lot of disclosures. These disclosures come from Companies Act, these disclosures come from the accounting standards. Now, are we supposed to, and there can be 20 subsidiaries, every subsidiary will have their disclosures. Okay, we understand how to prepare CFS, P&L, cash flow, that we already learned in Ind AS 110 in FR. But in Ind AS in FR, have you ever given the notes to accounts for the CFS? Have you disclosed anything in the notes to account? Probably the chances are very low. Like, what notes to accounts I should disclose? Should I give all whatever notes here given? Should I be giving it for the CFS also? Again, we are going to see in the basics. So what should be the notes to account? What should, okay, format is clear to you. Format should be the way the parents format applicable, okay, whether accounting standard or Ind AS, as told in the Schedule 3, same format the CFS will be prepared. So entity which prepares the CFS, either under any law, must suo motu engage the auditor for conducting the audit. That means when you are preparing CFS, CFS also needs to get audited. That's why it becomes a separate assignment. Auditor will be paid extra money. Specialists will be required because CFS is not a simple job. Okay, for our exams, we get simple exam questions, but in reality, it will be much more complex because somebody could have been doing fraud, which should be detected while you preparing CFS. Something could have been left outside the group, like Enron case. What they created special purpose entities. Because at that time, special purpose entities were not required to be consolidated. So what they did, they shifted some toxic assets from their balance sheet and they got a cash through that special purpose entity. Now, Ind AS 110 becomes so strong that you don't exclude anything. Even partnership firm is also getting consolidated because it talks based on the principles, it talks based on the controls. It doesn't tell subsidiary should be a company only. However, law or regulation governing may require the CFS to be audited by the statutory auditor of the entity. So, who audits the standalone financial? That's why in India, what is the rule? Statutory auditor should audit the CFS. Why? Because otherwise, You could have appointed somebody else, but that person may not have that understanding of the entity and the environment. That's why we have a rule in India that the stat auditor should only take your CFS audit. Followed? And if he finds that in the CFS there is one subsidiary whose share is 60% and you are not appointed as an auditor. Now SA 600 says that you should consider should you accept this CFS or not. Why? Because majority material portion of this CFS you are not done the audit. So that's the first step in SA 600, accepting the position as a principal auditor. So you need to see, do you have the knowledge of that subsidiaries? Is that subsidiaries material? Because ultimately when you have expressed the opinion on the CFS, it is your signature and your opinion. You may tell that that subsidiary audit I didn't do, but that is not going to absolve you from the responsibility for the opinion. So you should have followed the SA 600, you should have followed Ind AS 110. So there is a guidance note given on the audit of consolidated financial statement. So now rest of the language what you are going to see, it is coming from this guidance. See, up to chapter number 11, from where they picked? They picked it from the SS, SRE, SAS, whatever. Chapter number 12, they have taken it from different sources. Okay, this is like from technical guides and all, maybe there is a guidance note. So chapter number 13, they have taken these contents from the guidance note on audit of financial statements. So tomorrow if you become a consolidated auditor, we don't have any standards on auditing for CFS, but we have got a guidance notes which is recommendatory. So tomorrow if you open that, actually that guidance note is very big, but they have given you limited constraint extracts of that guidance notes here, because otherwise no, this itself another would, it would have become another subject there. Next chapter, chapter number 14, where the contents are coming from? Guidance notes on bank audit, guidance notes on NBFC audit. Did they give you every content? No, that is actually itself is one module, one book. They have given you relevant portion. That's why students, once you have understood from where these contents are coming, why I should be learning this language. Tomorrow, no, it becomes, see, maybe you may join some audit firm. Audit firm may assign you responsibility that you do this CFS audit. Now tell me, should you not understand guidance? No. As a CA, it becomes your responsibility and they expect you to understand the terms, terminologies, because you have to interpret. That's why let's go through this and get the flavor of what that guidance note talks about. Now, the guidance notes provides a very specific guidance on the audit issues and the procedures. It is very extensive, but we will see in a limited case. But it does not deal with the accounting matters. Now, who is going to deal with the accounting matter? There is a guidance notes on Ind AS 110. That can talk you on how the accounting issues has to be addressed. It will talk only on the audit part of it. So what we are going to see now is not from the guidance note on accounting of the Ind AS 110, but we will see from the consolidated audit. Now there are two standards, accounting standard 21 and Ind AS 110, depending upon whichever is applicable. Whenever a parent decides to prepare, it should do in accordance with the requirement of the whichever accounting standards or Ind AS applicable to them as per the relevant framework. Okay, so we will move on. We'll start with the basics. Did we start anything? No, these are all simple. Forget it. Done. You listen to me enough. Okay, the very first thing we will start with the sub concept. What was that first concept? Introduction, basics. So why CFS is required? Which format they should be prepared? Who should prepare it? Okay, we have understood. Now, first question comes, is this mandatory or is it an optional? If it is mandatory, can I leave some of the subsidiaries? No, who can give me this guidance? For this, we have to go to section 129(3) of the Companies Act. First of all, why you should prepare P&L account and balance sheet? Who told you? Companies Act only told you. Similarly, section 129(3) says that where you have got one or more subsidiaries, including associates and joint venture, in addition to your standalone financial statement, you should also prepare the CFS in the same form and the manner, just like it's your SFS. Okay, so one thing it has come on your head that you have to prepare CFS if you have subsidiaries, associates, and joint venture. Now, who is my subsidiary? Now, who will going to define it? Your account Companies Act also may define, but accounting standards or Ind AS specifically defines who is your subsidiary, because they accounting standard talks from the perspective of rules, 51% of the voting rights. But Ind AS talks about the rule principles that you have got control. Okay. Anyhow, we need not go get into it. Now, the moment somebody becomes like you have acquired a control, yes, you may have to prepare. And MCA has come with one notification which says that if there is any conflict when it comes to accounting between Companies Act and Ind AS, generally, whenever there is a conflict between Ind AS and say Act, okay, ICA pronouncement, professional standards and regulatory requirement, who will survive? Always the law and regulation has got an upper hand. But when it comes to accounting matters, MCA has given a very clear-cut notification. Look, Baba, other matters, yes, we have got an upper hand. Whenever conflict comes, law prevails. But when it comes to accounting matters, if there is any conflict between Companies Act and the Ind AS or accounting standard, your Ind AS or the accounting standards will prevail. So this is what we need to keep in mind. Now, section 129(4) says that the provisions of applicable, like why, in which context I am telling. Now, as per your Companies Act, someone may not be your subsidiary, but as per Ind AS, they might become your subsidiary. Now, should I prepare CFS or should I not prepare CFS? So, since Ind AS becomes applicable to you, and someone has become your subsidiary because of the control logic, not because of the rule logic, you have to prepare as per 120. You cannot say, look, Baba, law is superior, I will not prepare. No, that's not going to operate. Okay. So, depending upon what your law has told, accounting standard or Ind AS, okay, as per that, are you a subsidiary? Yes. In that case, yes, you have to prepare CFS. Now, section 129(4) said that the provisions applicable to the preparation and adoption of the holding company shall mutatis mutandis, means as it is applied to the CFS also. So, you should prepare the way you prepare your SFS, the format, the manner, the applicable provisions, the rules, everything becomes applicable. The CFS shall also be approved by the board of directors. It should be laid before the AGM and it should attach a separate statement containing salient features in form number AOC1. Who told you this? Companies Act told. That means along with the CFS, one more format, one statement should be attached. Statement means what? Is more like a report. Okay, it is some details. In which format? The detail has to be presented in format number AOC1. Like what is that? See, this is what they have given in the CFA, Companies Act. That you should give information, like first column should be serial number, name of the subsidiary, from when you acquired it, okay, what is the reporting period of the subsidiary, what is the share capital, reserves and surplus, like the gist or the extract. You see here, part A, subsidiaries, a statement containing salient features. Features means something visible from the outset. Like what is the total liability? We can just, by looking at their balance sheet only, we'll know what is their total liability, what is their total profit. So what we need to give one summary statement, like who are your subsidiaries? Now, when is your reporting period? What is their share capital? So along with the balance sheet and the P&L, along with the CFS, we have to give one statement like this. And this format is given by in form number AOC1. I hope it's clear, students. Now, according to the company's accounts rules, CFS shall be made according to the provision of Schedule 3 and the applicable accounting standard. So, first part is clear to you. Is it mandatory? Answer is yes. Whom? Section 129(3) is going to tell. Whoever is having subsidiary and associate. Now, who is your subsidiary or associate? Companies Act also will give definition, but they say that you refer to the accounting standard definitions or Ind AS definition. Okay, second question comes, can we leave some of the subsidiaries? Or I have got one subsidiary, but do I have got any exemptions from not doing the consolidation? One thing we understood what is mandatory. The second question, do you have an exemption? Okay, however, company not required to prepare CFS as per the accounting standard. That means they must have got some exemption or somebody is not your subsidiary only. It is sufficient that the company complies with the provisions of CFS in Schedule 3. What is that? That means if you are not required to prepare the CFS, why? Because you got certain exemptions. Are they subsidiary as per Companies Act? Yes. But why you are not preparing? Because you must have got some exemptions from preparing. You will see that exemption. Then you need to comply with the provisions of Schedule 3. What is that? You have to prepare this statement. This exemption is not there for you. That means if you have exemption from CFS, only consolidated balance sheet P&L will not be prepared. But this statement you may have to provide. You have to comply. Okay, now one question comes, when CFS is not applicable, when I get such an exemption, okay, now Companies Act says that CFS shall not apply if the following conditions are fulfilled. Again, we have already seen this, similar exemptions are available in India's 110 also. If it is wholly owned subsidiary or a partially owned subsidiary of another company, and all its other members, who are those other members? NCI in case of partially owned, because in case of wholly owned it is not applicable. Otherwise not entitled to vote also, like preference share capital, preference holders have been intimated in writing and for which the proof of delivery is also available, and they do not object to presenting CFS. So what they are trying to tell here, first condition is you have got a parent company like this. This is the parent. So you have got 3 investments. Now, for example, in S1, S2, S3, you have got 100%, you have got 80%, you have got 75%. So in this case, your 20% is NCI, 25% is a non-controlling interest or minority interest. Now, in this case, I need not bother. Now, first question comes, should I prepare CFS? The answer is yes. Now, one more question comes, what if this will have subsidiary number 3 or sub-subsidiary 1 and they are holding 100%? These people are holding 100%. Okay, now question comes, is this intermittent person need to prepare CFS? We are talking about not about this ultimate parent. We are talking about this intermediate parent. Now, this can have, okay, let us take, okay, simple example. That is not much complicated. Okay, so let me bring one simple example like this. Let us not take so many scenarios. We have got a parent has got a subsidiary 1, and this has got 2 subsidiaries, subsidiary 1, SS2. In this case, you have got 100%, 80%. Okay, this type of questions are there in FR. Now, first question, are we talking about them exemption? No. But are you supposed to prepare CFS? Yes, because you are also a company. You are also supposed to prepare CFS. Now, first question comes, do S1 have got an exemption? Yes, when first it is a wholly owned subsidiary or a partially owned subsidiary, that means a scenario 1 or 2, and your other members, who is your NCI 0 or 20%, including those non-voting, agree, they say, okay sir, we don't want. First condition, the subsidiary says that we don't want. This NCIs, everybody agree that okay, we will not prepare CFS. Okay, the second condition is the company whose securities are not listed and they are not in the listing process, whether in India or outside India. That means this S1 should not have been a listed entity. Because if it is a listed entity, you have to prepare CFS because investors want to see that. Or you are in the process of listing, then it also will not give you exemption. That means you are a closely held company. That means you are not a listed company. You are an unlisted company. You are closely held. So many general public are not involved. And the third, ultimate or the intermediate holding company files CFS with the registrar. That means this person is preparing CFS. So what is going to happen? See, understand the logic of why exemption is required. If this entity also goes for CFS, again the auditor has to be appointed. One CFS will be prepared at the parent level, another CFS will be prepared at a subsidiary level, and this CFS is again getting consolidated there. It's a waste of cash, right? Because ultimately, this is an unlisted company, it is a closely held. Now, the minority interest may be very small here. CFS at the parent level is already prepared. So some investors can go and look at the parent level, how that is getting consolidated. That picture so they will get here. Then why again I have to carry on one more exercise? That's why they gave an exemption. Companies Act gave you an exemption. India gave you an exemption. that if your ultimate parent is preparing, your other non-NCI holders are agreeing, you are not listed, then this intermittent subsidiary need not prepare. But if the ultimate parent happens to be a human being, not a P limited, then human limited has got no obligation to prepare CFS. If you are an individual and in your individual capacity you are holding 100% of S1 and not a company is holding 100%, in such cases that means the structure can be like this. Instead of, see, there can be two structures of the parent. S1 would have been held by P1, P limited, parent limited, and parent limited shares are held by the human being, or S1 shares could have been directly held by a human being. So in this case, we will not get exemption because this human is not supposed to prepare CFS because Companies Act is not applicable to them. I hope, students, this exemption concept is clear to you. Perfect. Yes. Now, section 129(6) says one more exemption it gives, that if you happen the central government on its own, or you can apply to the central government for a class of companies, they can exempt it from complying with the class of company. They will not give you for individual companies. So as individual companies, you don't apply. For certain class of companies, okay, if they feel that consolidation may not add much value, or maybe they form to say defense sector and they don't want to show that consolidated picture, they may have it internally, but they don't want it to show that consolidation wise how it looks like. Okay, so maybe they may grant in the public interest, they may grant such exemptions either conditionally or unconditionally. That means exemption number 1, this is for intermittent subsidiary. Exemption number 2, for class of companies, government can give the exemption. Thus, the companies having subsidiaries which have previously never prepared CFS must start preparing and adhering to the mandatory requirement. Then the third exemptions are going to come for investment entities. Now, investment entities need not present the CFS if it is required as per 110. So, this is available for, these two things are available under Companies Act. But one more thing is available under Ind AS. That means if you happen to be an investment company and you measure your all the subsidiaries at a FVTPL, beautiful concept. Then word itself catch the heart. Okay, so you are going to measure it. So then you need not prepare the CFS. What is the logic here? Okay, who is an investment company? See, when you have got, say, acquired the control of a company. Now, why you acquired the control of the company? For this, we have to go to the strategic management chapter, which you studied at the intermediate. Because you are looking to capture the market share, you are looking for some synergy. So this is P limited and this is S limited. Now, this could be a diversified diversification, or it can be backward integration, it can be a forward integration, it can be conglomerate diversification, or okay, there must be some strategic reasons why you are acquiring this subsidiary. Somewhere they must be connected to your line of business. That means whatever your product you are manufacturing, selling into the market, they may be your competitor, they may be your substitute. There must be some strategic reasons why you are acquiring. Okay. But if you talk about companies like LIC, now they have invested, say, S limited. Now, what is their objective? Are they connected to their business? Okay, is they going to help them to do sell their policies? No, they are looking this particular just like one investment. So if it is an investment, Ind AS 100 tells you give certain things. That means you can have an option of valuing them at amortized cost. But if your objective is to hold them for trading, suppose tomorrow you get a good price, you will sell. See, here you are not acquiring this to sell because you want to take that operational synergy. But here your objective is to sell. You don't want to hold it. You don't want to interfere in their manufacturing. They don't give you any synergy to you. So you may end up measuring at FVTPL at a fair value. So now tell me, students, what is the fun in consolidating their financial statement with LIC's financial statement? Actually, it will distort the financial statement of LIC only. But here, no, it gives you a very good picture for the investors. They can understand the synergies. Here, so no synergy only. That's why there is one more exemptions coming to investment entities, that if you are measuring your subsidiaries, because you may happen to invest more than, or you may get that even by putting 10% investment, you may control the board of directors. Who is this LIC? But your investment you have done not with an objective to govern that and make the profit out of it, but to look for your benefits for your investment. That's why even though it is a technically your subsidiary and you measure it at fair value, you need not consolidate. Now one question comes now, who is an investment entity? Now will auditing standards or guidance note on auditing standards define? No, again your Ind AS 110 only will define. No, it says that look, the nature of an investment entity will be they obtain funds from other investors for the sake of investment, not to set up in plant and machinery. Like MRPL is not an investment entity, okay, but your Goldman Sachs is an investment entity, LIC is an investment entity, because they get the fund from investors, okay, for the sake of doing investment management services. Second, they commit to the investors. Its business purpose is solely to get the returns in the form of capital appreciations or investment income. They don't guarantee that, look, we will give you business profits. We will see to it that your business will give 40-50%. No, your investment will give the returns to you. So it really doesn't matter whether you are going to invest in MRPL or you are not going to invest in MRPL. So for them, company is not important. For them, investment is important. But if somebody is acquired, a parent has acquired, like ONGC has acquired MRPL, they are looking from the synergy point of view, their business point of view. And third, they should measure and evaluate the performance of the subsidiaries at a fair value basis, FVTPL basis. No, there is one examination question they can ask you. Is it mandatory? Then you can talk about section 129. You can talk about exemptions, what you are going to get. So there are 3 exemptions we have understood. I hope you are very clear. First exemption, 2 exemptions are Companies Act. The third exemptions come from the Ind AS. And there is one more exemptions coming from your accounting standard, which they have not discussed here, but we are going to discuss later. That means if you have got, let us see, I will tell you, okay, then let me complete this. And the parent of an investment entity shall consolidate unless parent itself is the investment company. Okay. So what a parent of an investment shall consolidate all the entities that it controls unless that parent itself is an investment company. Okay, that means if this parent LIC is held by somebody else, they may have to consolidate, but if that parent is also an investment entity, they need not consolidate. And tomorrow, this parent LIC may have another investment entity. That they have to consolidate. They need not consolidate only the business entities, like who are into manufacturing, service and all. But LIC, it's like itself is having another investment entity that has formed it. That is, they may have to consolidate. Now, one more exemption is coming from the accounting standard, which is not there in Ind AS. They say that if there are 2 conditions, if you have acquired a subsidiary on a temporary basis, that means within next 2-3 months you are going to sell it, only for some reasons you have acquired for temporary way, then you need not consolidate. Or second, if that subsidiary is operating under severe long-term restrictions to transfer and pay the dividend to you, that means you ultimately, when you acquire a subsidiary, why you acquire? Because when whatever profits that subsidiary will make, you want to get it transferred to you in the form of dividend. But if the company, that subsidiary has got restrictions and it cannot transfer funds to you on a long-term basis, then better don't show the consolidation till that restriction exists. Anyhow, this is the 4th exemption which we will get only in the accounting standard. I hope students you are very clear. You can write the answers. Yes, now they gave you a case study. Parent acquired 51% of the shares on 31/3/2024. Now during the year 23-24, 20% of the shares were sold by the parent. Okay, so you acquired during 31st March 2024. Now during the same year, you have sold some 20% also out of 51%. That means while the parent is preparing the financial statement on 31st March 2023 and 31st March 2024, they did not consider the financial statement of child for consolidation. How? First of all, you acquired when they didn't tell you, maybe in the month of Jan. Okay, you must have acquired 51%. So on 31st March 2024, are you supposed to prepare CFS? The answer is yes. Now by March, you must have sold 20%. Now You became only 31%. Is it your subsidiary? No. Now, are you supposed to prepare till at the end of the year? That's the confusion which has got created. Now, they did not consider the financial statement of child for consolidation. Now, how you are going to deal with it? Okay, first question comes, where did they had a subsidiary? Yes, so they have to prepare. Now, did they had any exemptions from preparation? Otherwise, no, they have to prepare CFS even though it was subsidiary for the part of the year. Now, in Ind AS 110, there is no such exemptions called a temporary control or for operation under severe long-term fund transfer restrictions. This is that fourth exemption I was talking about. They didn't tell you directly as a theory, but they are telling you as a case. So, consolidation is mandatory for Ind AS compliant financial statement. However, section 129(3) says that a company having subsidiary is not required to prepare CFS, need to comply with the provisions of Schedule 3. Okay, preparation of the statement and showing the statement. So in the given case, parent limited has acquired 51%. They did not disclose, so they told the story here. Intention of the parent is very clear that the acquisition of the child is only a temporary. So if the accounting standard is applicable to them, they need not consolidate. So parent is required to prepare CFS as per 110 because temporary control concept is not applicable to them. Okay. So for the operation in the severe long term is not available 110. So if they are talking 100 Ind AS 110, they have to do the consolidation and they have to show just like 110 what they say that when you lose the control, how to prepare, whatever, all the statements and all. But if you are talking about accounting standard, you need not prepare. So consolidation of an investor shall begin from the date investor obtain the control. When, if you are accounting standard, Jan, and it should end when the investor loses the control, when March. So for this period, 3 months or 2 months, you have to prepare CFS. You have to show them. Now, there are so many questions related to this basics part. Okay, so let us see now, test your knowledge one, and this should build your knowledge about these exemptions and mandatory thing. So first you test your knowledge one, whether the consolidation preparation is mandatory. Yes, please elaborate the requirement. So what you are going to tell, section 129 you are going to tell, then you are going to say exemption number 1, then you can tell about the exemption number 2, then you will tell about the exemption number 3, and you can talk about exemption number 4. They said refer para number 11. Very easy. Now, please elaborate the situations where the requirement related to preparation may not apply. What is that? Exemptions. So again, you are going to talk that if it is not applicable, then you have to prepare in format number AOC1. So you have got certain exemptions given. Okay, whatever that first para, you can write about first para. So you can write about exemption 1 here, exemption 2 here, exemption 3. And you can also write exemption number 4. Okay, you can write only part of the exemption because they said when you need not prepare. Okay, now let us see application related question. R Limited owns 51% of S Limited. However, they hold and disclose all the shares as stock in trade. First question comes, is R Limited a investment entity? When you can call it as an investment entity, 3 conditions should fulfill. Okay, we don't know till now. Because if investment entity and what is applicable, Ind AS is applicable or accounting standard, also we don't know. If it is 110 applicable and if it happens to be investment entity, yes, we will give exemption. But if it is accounting standard is applicable and this is temporary, stock in trade, then also we will give exemption. But if you are accounting Ind AS 110, but you are not an investment entity, you have to consolidate. The shares are held exclusively with the view to subsequent disposal. Now, R Limited represents that CFS can be excluded. How would you deal now? Now, see, the question is subject to a lot of interpretation. I have marked it as important because they didn't tell you now whether entered AS is applicable or Ind AS is applicable. Whether R is a what is it called? Investment entity or not an investment entity. So you can form accordingly the answers. So you can talk about that para, that exemption is not available. Okay, this we can connect to this type of this case. So you can talk about this issue. The exemption is not available, so you have to prepare like this. So control is temporary. So they are required to prepare CFS as per 110. In case the management refuses, you have to disclaim or qualify your opinion, disclaim the opinion. Okay, if you can tell it from the AS point of view, we can say it is not required. If you say AS 21 is applicable. Yes, now we will go to test your knowledge 8 question. M acquired 51%. This is which question? Test your knowledge 5. M acquired S on 1/4/2018 and immediately sold 25% of the shares in 2018-19 only. Okay, that means this is temporary. This is similar to the case what we had discussed. You see now two different answers. No? M Limited did not prepare CFS on the plea that the control was temporary. Do you agree with M? Decide, assuming M has to prepare as per Ind AS. And you say no, because temporary is not given, consolidated has to happen. So they are required to prepare the CFS. What if in the examination they will twist and say bring AS? Then you say consolidation is not required. And then you can also add a line, however, if it was in this, then it would have been required. So if you have got a confusion, then take your assumption. Now, H Limited is an investment company. Here only they told investment company preparing as per Ind AS. So that means they must be fulfilling all the three conditions. Otherwise, the question may be such that you have to identify that and tell that, okay, H is an investment company. For this to write the 3 points, now you will get 2 or 3 points, 3 marks. But in this case, I don't think so we have to write that because they only told you it is investment company. Okay, to be on the safer side, you can always write. You can present the answer in a beautiful format. The company obtains funds from investors. See, what if they tell H Limited obtains funds from various investors and commits its performance for fair return for capital appreciation? Okay, if they miss this sentence in the examination, then first you should prove by looking at this answer that it is an investment entity. Then it will fetch you mark. But here, no, they have already told. Now, during the year, it has been observed that the company has invested 25% in S1 and 50% in S2 and 60% in S3. While checking the investment schedule, issue cropped whether this would arise need to consolidate in accordance with section 129(3), which contains no exclusion from consolidation for investment entity. Now analyze the issue and involve and give your views. Okay, so since you have to analyze, first you tell, okay, is it an investment entity? Okay, is consolidation is really required? So first you can tell always your answer, yes, section 129 says, 129(3) says a consolidation is required. Then Ind AS 110, have they told in 110? Yes. 110 gives exemption to investment entity. So in the given case, H is an investment entity. So Companies Act, they say that, okay, if you are not going to prepare, then you have to prepare the schedule as per required. So who is an investment entity? You will tell that, yes, in the given case, it is an investment entity, and 110 gives an exemptions. So we can conclude, thus it can be concluded that ultimate authority on consolidation is Ind AS prescribed by the law. If it gives some exemptions, then you have to give the disclosure in the notes to accounts. If it out of exemption of subsidiaries are not consolidated, then list should be disclosed in the notes to account. It can be concluded that the ultimate authority on consolidation is Ind AS as prescribed by law, and if they give some exemption, it should be followed. That means you should exclude it. If out of exemption some subsidiaries are not consolidated, yes, you should disclose the notes as told in the form number AOC1. You have to give that AOC1 disclosure. You can exclude it from the consolidated financials. So many questions. Okay. Now, Jumbo and Sudharma Investments. See, this word only will tell it must be investment company. It has got subsidiary Investors Fund Management Limited. Investors Fund Management Limited. Major business is to pool money from the investors. This company pooled 12 crores from number of clients, which represents company shareholders. Now, while auditing the books of Jumbo Sudharma Investments, Vardhaman observed that the amount of 12 crore pooled investment debentures of various companies, profit and due to appreciation of these shares have been distributed to various shareholders. Performance is measured at a fair value basis. Okay, from this context only you understood that this is chapter number 13 they are talking, and concept number 1 about consolidations, because they are speaking that this is investment entity and all. Rest of the topics we are not going to speak about it. Now, CA Vardhaman raised an issue while auditing whether the CFS is required. So concept number 1. Analyze the issue. Okay, it's a very similar answer. You will write all the same story and say it is not required. Now, Advik Investments is paid up capital of 1 crore. Okay, while auditing 12 crore. Okay, it's the same. I don't know. I should have clubbed it with the previous one. Analyze the issue. You write the same story. And finally, you say it is not required. So that applying to the provisions, not, it can be concluded that Advik is not required to prepare as per Ind AS 110. So be careful, students. If it is accounting standard, they may require the consolidation. Okay, let us see the accounting standard related provision when it applies to investment entity. Okay, so this is all about the first part where, no, not first part, in the concept. Concept 1 is basics. In basics, first part we discussed, sub concept number 1. Is it mandatory and what exemptions are there? And so many questions we have seen. Second, the sub concept. What is the responsibility of the parent? Okay, now the responsibility of the parent, mark it very important if it is not come for the exam. Because they have given you in the pictures, in the colors, with the box. First, their responsibility is to identify the component which has to be included in the financial statement. Because they know, are they controlling it or not? Because we cannot just go with the rules, 51%. Okay, as a part of, in SA 600 says, okay, what is the procedure you have to see? You have to see, go and check the register, return file with the ROC and all. That's fine. But are you really controlling an entity or not? That you know. So first you identify, that is your responsibility. Now, where appropriate, identify the reporting segments. Why? Because operating segment, Ind AS 108 becomes applicable to you at a CFS level also. Because what is the reporting segment at SFS level may be totally different from reporting segment at CFS level. Because 108 says that you have to give that segment wise reporting. So identify which is that reportable segments now. Now you have to identify the related parties transactions, because a lot of eliminations and disclosures has to be given now. Now someone is related party to you or not, you only know. Ind AS 23 is there, Companies Act says. Okay. Now according to that you only identify, because you have to give disclosures. Elimination has to happen. Give complete accurate information about the components. Explain them in the notes. What all adjustments are required? Consolidation. How many adjustments? 2 adjustments. Permanent adjustments, current period adjustments. Both the adjustments you have to give. Harmonize their accounting policies and accounting framework. They may be as per US GAAP, because the subsidiary is sitting in USA. For you, Ind AS is applicable. See, there is no such situation where parent Ind AS is applicable, subsidiary accounting standard in India. Because we know that. Ind AS applicability chapter you must have learned that if parent is applicable, subsidiary also becomes applicable. But what if your subsidiary is sitting in USA? You cannot say no, Ind AS, they have to prepare as per Ind AS. For them, they will prepare as per US GAAP, UK GAAP. So consolidation should happen at Ind AS. That's why there's something called a harmonization or conversion of the framework. Whose responsibility it is? Parent's responsibility. Now in India, the subsidiary may be following FIFO. You are following weighted average. Now this harmonization of accounting policies also has to happen. Ind AS 110 talks about these problems. You remember, you know, no? You have done Ind AS. You see, who should do that? Management should do that. Gap conversion is their responsibility. This is the gap conversion, like foreign gap into Ind AS. So these are all the 7 responsibilities of the parent. Please mark it very important, students. They can ask you this questions. Now, apart from above, do you have any other thing where the parent ordinarily issues instructions to the managements of the components, specifying parents' requirement for the financial information of the components? Okay, so they have also got a responsibility to tell their subsidiaries, look, Papa, we are preparing like this. So our auditors may coordinate with your auditors. So please give whatever information to our auditors. Otherwise, we will change the board of directors in the subsidiary. The instructions ordinarily cover accounting policies to be applied, and they can give an accounting manual, and they say, look, your accounting should happen like this, because tomorrow, or we may tell that there is one software called Hyperion. Now Hyperion is a software which will do the consolidations, because it's the consolidation expert. Now management can give, the parent management can give instructions to the management of the subsidiary. Look, these information you feed in the Hyperion, because we want to see that Tomorrow, we should not take a huge volume, like huge time to prepare CFS. It should happen very easily as per India's. So feed your data in this format in Hyperion. That's why students, when we were working in Vedanta, along with the monthly closing, we had one more responsibility. After our closing is done, we have to convert our financial statement in one particular format. We call it Hyperion format, and we used to upload into Hyperion. Why? Because it used to get consolidated at the parent level. So who gives that instruction? The parents give. They follow up. So, and they can ask for other disclosures required on the reportable segments, related party, etc. So they can give instructions. Now let us see test your knowledge 4 question. Again, see simple. Write a short notes on the responsibility of the parent. Will they ask you this type of questions in the exam? No. But since they have given you in the form of picture, test your knowledge is going to come in the form of, see the question what they are asking. No, they may ask you in a very tricky manner in the examination through some case. But if you figure out this question, please jump on it. Please write this question first, because it is very easy to answer. No tricky language is included. Okay, simply write 4 or 5 points. You got full 4 or 5 marks. So please understand, our ICA will never ever give this question so easily, because this answer is very easy. There is no complication in the answer. Question looks very simple. That's why they are going to give a case. Somewhere they will give you hint that they are talking about chapter number 13, concept number 1, sub concept number 2. That's what you need to figure out. And then you have to write about this response. And they have given you a picture also, like with the color. Yes. Then, what is the responsibility of the auditor? So we should talk about always when we speak about the responsibility of the management. Very next statement is the auditor. Section 129(4) requires that the provisions of the act applicable on the preparation shall become mutatis mutandis applicable, that we have already seen. And principal auditor of the CFS shall express opinion on the CFS in accordance with the reporting framework of the parent. Okay, now there can be something more like section 140. Okay, now one question comes: what should be that additional disclosure? What should be the rules of consolidation? Is section 143 subsection 3 talks about like reporting requirements? Am I supposed to do it? Is CARO applicable? Yes, which is that the last clause number 21, para number 21. That means if your subsidiaries have given any subsidiary auditors are given observations in the CARO, qualifications in the audit CARO, that you have to consider consolidate, but not up to point number 20. Is ICFR applicable? Yes, applicable. But which ICFR? Consolidation related ICFR only. Okay, so this is all the auditor need to be aware. This becomes their responsibility. Their responsibility is to express opinion. Therefore, the auditor's objective is to satisfy point number 1. You can mark this also important, that CFS is prepared as per the applicable framework like Ind AS 110 or AS 21. Second, they need to express opinion whether it is true and fair view. Why? Because Companies Act says the true and fair view word has to be used. You have to make inquiry because section 143(1) becomes applicable. At what is that inquiry you need to make? Is there any accounting entries prejudicial to the interest of the company? Have you given loans and advances which is prejudicial to the interest? Is there any personal expenses are charged at the group level? Because it can somebody at the subsidiary level it must have been charged. Have you issued the shares other than cash? So you have some 7 inquiries to be made. Then do you need to report on the matter? Section 143 subsection A to I, like have you got the books of accounts have been prepared, whether the reports of the branch have been received by you. Okay, those points. Okay, whether the dividend has been declared as per the rules. Is there any material unsupportable losses? So those points are you supposed to prepare? That's what you need to check and validate the requirement for preparation of the CFS as per the requirement, as per the reporting framework. So these are all your responsibility of the auditor. Now standards on auditing, statements and guidance notes issued by the ICAs also become applicable. So now guidance notes becomes applicable to you. So it is only recommendatory. They also apply to the standalone financial statement. It means that the auditors, while conducting the audit of CFS, are expected to 1. Plan their work as well as 300. Obtain understanding of the internal control system, IT systems of consolidation tool, Hyperion. You need not understand about the entity environment and all here, because that you have already understood for the parent. If some subsidiary is material, you only would have done their audit also, because otherwise you would not have accepted consolidation audit. But here, what you need to plan and obtain understanding, like how do they consolidate now? What type of tools they are using? Is it manual or automated consolidation? What should be my nature, timing, extent of the procedures to verify the consolidation? Now use your professional judgment as per SA 200 to risk to reduce acceptable low level. Okay, so this is your responsibility of the auditor. You can talk about this responsibility and specific responsibility as per the standard, because every standard becomes applicable to you. So whatever standards are applicable for your SA or standalone financial is applicable here also. So you can think about using the work of internal auditor, bringing an expert, SA 620, okay, sufficient appropriateness of evidence, test of control, substantive procedure, everything becomes applicable here. Yes, with this, no, we are done with the first standard. One minute. Foundation, the first standard requirement. No, I think one more thing we have got. Yeah, auditing consultation, like the last part, last panel. Okay, so concept number 1 is about the basics. In that, first thing we learned about the applicability and exemption. Second, responsibility of the management. Third, auditor's responsibility. Fourth, audit considerations. Now, what are the CFS features impacting audit? Now, following features of the CFS are going to impact the audit. So, consolidation financial statements will be prepared using consolidation procedures of accounting standards or Ind AS. So, first thing you need to know how the management is going to prepare. Who is going to tell the rules of consolidation? AS 21 will tell, or Ind AS 110 will tell. Then, auditor of CFS may use the work of other auditors. Then SA 600 becomes applicable. So these are all the features of CFS is going to impact. First thing you need to consider, what is applicable? Accounting standard is applicable or Ind AS is applicable? Are there subsidiary auditors, or I only have got the audit of that? So these are all the very important features of consolidation which is going to impact your audit procedure, which you need to consider. Followed, no? The first thing. Then other financial informations. Okay, you can write these heading students, otherwise they have gone into para. So what are your considerations? What is that you should deeply think? Okay, I will tell you, while the government in fact, while speaking previously, it didn't strike me. Okay, students, very nice question. Why government is going to give exemptions? Very, very fantastic question. Okay, when I was preparing, no, it didn't strike me. Today, when teaching, automatically it struck me, because I gave on some defense example and all. Let me give you a very proper example why government is going to give exemption. But later I thought, okay, let me check this later, because if this question would have struck me when I was preparing, I would have given you answer right now. Okay, but thank you for the questioning. I'll check and I'll tell you. Okay, under what circumstances government will give exemption? Okay, and yesterday one more thing, that IT related things we discussed. No, in that IT related thing we spoke about RPA. Okay, I will talk to you about separately, because at the end, till now they have not asked any question. Okay, they said accounting standard, para, recognition, ICFR. Okay, I will tell you, students, with the proper example, I will explain you one scenario, like what exactly they are trying to tell. Then one scenario understood what is that they are trying to tell. Again, because when I was teaching you yesterday, I felt that okay, I should have worked more, because that explanation was not sufficient. I will tell you this also. Okay, so I was actually working on that. Yes, this part also I will explain it. Maybe in my next session I will tell you. Now, what is that special considerations, or what you should deeply think? Okay, one thing is, which, since your consolidation is dependent on the framework, accounting standard or Ind AS, what is applicable? That's what you need to think. Now, who is the auditor of subsidiary? Whether you or someone else, that's what you need to think. So I can say, this is point number 1 you need to consider. This is point number 2 you need to consider. The point number 3 you need to consider is something called other information. Okay. Okay, we can remove this point, students. Heading you can remove. What is the feature of CFS you need to consider? Yes, one, something, what accounting standard or Ind AS is applicable, because that is going to completely change the way you are going to audit. Are there other auditors, and what about the other information? Okay, what is this other financial information? Now, the consolidated financial statement, including the intermediate consolidated statement, which is prepared internally, are prepared using SFS. You know that CFS is prepared from SFS of the parent and its component, and also other financial information which may not be covered in the separate financial statement. That means something can come not from the CFS, SFS. Generally, CFS is prepared from SFS, but something can come in the CFS which is not sitting in SFS. They are called other financial information. Now, as an auditor, if you are going to audit the CFS, should you not consider such things? Because see, accounting standard, you know that every CFS is coming from SFS only. But if there something is coming in CFS which is not sitting in SFS, should you not consider that? Yes. Now, other information would include certain disclosures to be made in the CFS, which is not part of your SFS, like AOC1. You tell me, students, form number AOC1. Is it applicable for any of the SFS? No, it is applicable specifically for CFS. Now, what is that? You are going to tell components, their proportion of the items with the different accounting policies that we applied, adjustments to significant transactions that occur between the parents' financial statements and this. Okay, so those information, like information about components, okay, we can say AOC1. Now, what is the significant transaction adjustments? That also I'll explain you as we proceed. So these are all the examples of other information which an auditor has to consider. Now, we understood, okay, sir, disclosure related to components, we agree. Proportion of items to be included in the CFS with the different accounting policies also agree, because these things are not found in SFS, but they are found in the CFS. What is that? Adjustment for the effect of significant transaction. That means something is not found in the SFS but part of the CFS, which is found between the financial statement of the parent and components. That's something like, we will discuss it later. See, it is called a reporting period adjustments. What is this reporting period adjustment? See, reporting period adjustments are like this. Now, I am the parent limited. I am going to prepare the balance sheet on 31st March 2026. Now, I may have two subsidiaries. Now, one of the subsidiaries is an Indian subsidiary. They will also prepare the balance sheet on 31st March 2026. But what about a foreign subsidiary sitting in USA whose financial year ends on 31st December 2025? Because they don't prepare any balance sheet on 31st March 2026. Now, how do I consolidate them? Because I have got a SFS is dated on 31st December 2025. Here I don't have any problem. Now, I need to consolidate this plus all the subsequent transactions which happens here. Significant transactions or material transactions. That I need to be incorporated. So, this problem comes only if subsidiary is sitting in some foreign company and they follow different reporting periods. So, I may have to take some items and consolidate, and if any significant transactions happen, that I may have to include as a disclosures. Because this part may not be part of their financial, because their financial statement must have got signed by January and they must have issued to their investors. But when I consolidate, I will consolidate in the March. By that time, they don't have, the US subsidiary don't have any requirement to prepare SFS only, because their SFS is already prepared, signed, and AGM is also finished. Now, during this period, if anything happens, that has to be additional. Now, work of other auditors, this explanation, work of other auditors. Now, when the auditor accepts the audit of CFS, he should assess whether we will be able to express opinion. That means if 60% of the CFS values are coming from one subsidiary and you are not the subsidiary auditor, then you should decline this audit. Because you should give me the subsidiary auditor only, because I cannot participate as a principal auditor. So, you should view the participation may not be enough, okay, or sufficient. You should consider the work of other auditors. Now, group consists of, then consolidation example they are given. I don't know why. So, you can ignore this, friends, because already this point we have already seen here, and this explanation you can give as part of this. Now, they gave an example. Group consists of A, B, C. B has got a loan with A 100. How consolidation is going to happen? PP will get full, shares in subsidiary will get eliminated. Intercompany receivables, because they said they have got a loan of 100, will get eliminated. Then receivables will be full, debt will be full, and equity of the subsidiaries will get eliminated. Only parent will remain. This is a very simple example. Okay. Now, such other auditors of B and C might be the statutory auditors of separate financial statements. Now, if you happen to be that statutory auditor of that separate financial statement, now how it may work? Do they have the responsibility to respond to you, to help to you do the consolidation? Now, you understand, students. B Limited audit must have appointed some ABC XYZ as an auditor. Now, XYZ will audit only the B Limited standalone financial statement. Now, why he has to work with you? Why these auditors have to work with you? What is that? Why they have the responsibility? Because as per statutory requirement, they have an appointed to audit the B Limited. Why on earth they should be coordinating with you? They should fill the checklist. Why they should spend time on you? They can always reject, right? That's why this consolidation may become another assignment for them. They have to be paid fees now. See, that's why certain exemptions are given, because unnecessarily it is going to increase the compliance cost. Now, such auditors may be the statutory auditors of one or more components appointed specifically for assessing the audit of consolidated financial statements of the principal auditor. That means, now what happened now? Because of this time gap, reporting, additional requirements and all, we may require the help. Like your financial statements are in US GAAP. I have to consolidate in Ind AS. I cannot directly take that US GAAP financial statement. I need to GAAP adjustment audits. I need to prepare something called a GAAP adjustment. Now, who is going to help me? So, the management of the subsidiary can request their statutory auditors that please help our principal auditors to do this consolidation. So, this becomes their additional responsibility. The first responsibility is to sign SFS, which they have done as per the Companies Act or whichever act applicable to them. But since they have to help now principal auditors to consolidate, yes, now they will get one more assignment and they will be paid fees also. Now they will respond to you in the form of checklist. You may ask them to audit that principal item. They will listen to you. Otherwise, they will not listen. Now, statutory auditors of one or more components of the parent are also requested to assist the principal auditor. That's why it will constitute as a separate assignment to other than the conducting of the statutory auditor. Anyhow, this they gave you as information. You need not think it from the examination point of view. Now, SA 600 using the work uses the work of another auditor. If he decides to use, then he has to comply with SA 600. Ignore it, forget it. So, the crux of this particular consideration, okay, materiality you may have to consider. So, if you have to list the point, what all those points we need to consider? Auditor has to consider as part of the basics while accepting. One, what is the framework, AS or Ind AS? Because this is going to impact your procedure. Second, am I the subsidiary auditors or there are other people? If I am not the auditor, then I have to request the management to give them one more assignment to help me. This is I need, and in that case, SA 600 becomes applicable. Third, I have to consider, is there any other information which I should be incorporating? This is I need to consider other information. Then fourth, you skip all these intermittent things, straight away go for the materiality. Because you as a principal auditor must have set the materiality as per SA 320 for SFS of P Limited. First question comes, is SA 320 applicable to CFS of P Limited? Answer is yes, because sometime back we have seen all the standards, because even balance sheet is also same like P Limited. All the standards applicable because you are expressing opinion there. Please understand, it's just an expressing opinion, just like you are expressing opinion on SFS. So 320 becomes applicable. But is it the same materiality of SFS? Answer is no. Because you may have to decide another totally different materiality but for the CFS as a whole. So this is your fourth consideration as an auditor. Now, in carrying out the standalone statement, you may have to compute the materiality for the purpose of issuing opinion on the standalone for each of the component would be done component wise on a standalone. But however, with regard to the CFS, regard to the determination of materiality, auditor has to consider the following. One, auditor has to compute the materiality for the financial statement or for the group as a whole. Now, why? How it can be helpful to him? How he can use it? Okay, please note this. They can ask you one question: how auditor can use it? He can use it to assess the appropriateness of the consolidation adjustments, like goodwill, intercompany elimination. If they make some mistake, is it material mistake or it is not material mistake? Should I leave some consolidations or should I not leave consolidation? So it can help me if I decide the materiality for the group as a whole, and if they make mistakes in consolidation adjustment, I can evaluate using group materiality. Also, I can use this materiality to decide whether any components who are left out, should it be part of the scope or not, whether they should be scoping the additional components, or some of the components might have been left. Okay, there is no exemption also. Then should I report it? This is not material, it is a very small component, I can just leave it. Generally, we don't leave it, just to tell you. So to scope in the additional components, I can consider the materiality. The parent can also consider materiality computed to whole, whether the components financial statements are material to the group as a whole. Third, the principal auditor also computes materiality for each component and communicate to the component auditors, because they have to support to, because he believes, if he believes it is required for a true and fair view of the CFS, because I should tell what is my group level materiality, because when they are selecting samples, now they might have taken only 5 samples. From the SFS point of view, 5 samples may be okay, but considering I'm consolidating you at my level and I'm going to express opinion on the PP which you have verified, I may want, say, 10 samples for my materiality. So I should communicate my materiality for the group as a whole and how much I'm going to allocate, because that's the performance materiality. No, students, always you take a benchmark like total assets, multiply with, say, 10%. This is called overall materiality. What you do, don't you distribute it to the items of the financial statement called performance materiality? Similarly, you will arrive group's total assets benchmark into 10% and may distribute to all the components, subsidiary 1, subsidiary 2, subsidiary. So you tell them what is the materiality applicable to you as a component and what may be samples required. So now this is going to increase your effort. That's why helping to do consolidation is a separate assignment. Otherwise, they need not listen to you. They say, sir, Baba, I am certifying single financial statement, and in my judgment, 5 samples are okay. Why I should take 10 samples? If it is a group, it is your headache. You only come and take your additional 5. No, since you need that coordination from them, generally it will be given as a separate assignment. Fourth, the principal auditor also obtains confirmation from the component auditors that they are independent, code of ethics have complied. Okay, certain information required for consolidation and disclosure requirements also I can take, like primarily more like a coordination. So materiality is another important question they can ask you on a standalone basis. However, while considering the observations, for instance, modification or emphasis, etc., component auditor in his report, the principles of SA 600 needs to be considered. Okay, whether it is material at a group level or not. Like if you find one observation in one subsidiary, then you have got a responsibility to tell all the subsidiaries, see whether this is going to happen in your company also. Okay, is this material to me? Is it not material to me? How do you have dealt with it? So who is going to talk about it? SA 600 is going to talk about it. Now, ICS issued an announcement of paragraph and leave it. Okay, something using the another article. Therefore, the concept of materiality would be considered while considering the observation. Okay, so you can make this as a point number 5. Where you are going to use materiality? Okay, you are going to use to look into consolidation adjustments. You are going to use to scope for the component financial statement. You are going to use it for considering the observations made by the component financial statement. These are all the 3 uses of group materiality. 3 uses of group materiality: consolidation adjustment, scoping of the components, observations of the or modifications of the component auditors. Now, 2 other considerations are you have to communicate them and you need to obtain confirmation from them. That's it, friends. So this is all about your first concept called Okay, let's see now. The first concept is all about your consolidation basics. The next is your audit considerations. I think, yeah, we were in the audit considerations only. I only grouped it for your sake. 1 minute. So, audit considerations. Okay, we can start from here only. Audit considerations. So, this is your concept number 2. So, in concept number 1, what we learned? In concept number 1, we learned about the basics. Okay, is it required? Applicability, responsibility of management, responsibility of auditor. So, it's easy, right? Concept number 1, you talk only 3 things. Now, concept number 2, you talk about audit considerations. It's like before accepting the engagement, what you should consider. Yeah, no? Okay, you need to consider audit considerations have like acceptance procedures, like what framework is applicable, are there are other auditors, are there are other financial information, what should be materiality for the group as a whole. And then you do the audit, auditing the consolidation. Like how do you do it? This is more like this particular para, concept number 2, like audit consideration, I can say split into 2, accepting, planning and performing. Is it fine? We can break it like this: accepting, planning and performing. So in planning and performing, we talk about like audit plan, completeness in the scope, understanding of the nature, exemptions, applicability of exemptions. Okay, with this we are done with the concept number 2. So we can have one map like this. Concept 1 has got 3 sub-concept. Concept number 2 has got 2. Sub-concept 1 is acceptance. Sub-concept 2 is performance. Concept number 3 is your permanent and temporary adjustments. And 4th is your reporting. This way you can understand. So before we proceed, we had one question there. I think test your knowledge 12. So let us take test your knowledge 12 question. Okay, there is one case study also they have given. Okay, this is the same case study which we have already seen. Temporary control and all exemption related. Disclosure. Okay, this is next one. No? Next thing. Audit consideration. Okay, we have to solve problem question number 10, which we'll see later because I should have shifted it. Now, test your knowledge 12. CAH was appointed as the statutory auditors of MN, which is a listed entity. That means no exemption from consolidation, which has got 3 subsidiaries. The moment you see this, chapter number 13 should strike to you. 3 subsidiaries, 15 branches across India, or this can be SA 600 also. We don't know. We don't know. It can be anything. But the moment you see the subsidiaries, the chances are very high. It can be, because they would not have told 3 subsidiaries and all. We have already seen the questions. Generally, we used to talk about the branch. The auditors are duly appointed for the subsidiaries and the branches with regard to the determination of the materiality during the audit of CFSC. This keyword told that it is not SA 600, it is chapter 13. But chapter 13 has got 4 concepts. Concept number 1, are they talking about the basics here? No. Concept number 2, are they talking acceptance and performance? Yes, because concept 1 is acceptance, which you need to consider materiality at the time of performance. What should be your considerations of H? Now you have to write the specific points of consolidation materiality. How should he deal in his report if there is an observation as per 706? Fantastic, easy. If this question comes, you should straight away jump because you figured out what exactly it is. Now, yes, should consider the requirement of SA 600, but not relevant here. Yes, this is the relevant portion. That compute the materiality for the group as a whole and use it for consolidation adjustment. Determine whether the components are material. Communicate your materiality to component auditor. Obtain confirmation from them. And concept of group is also considered for the observation of the component auditor. So that the second part of the question. How you should consider, how should deal? Yes, you can write about this para also. That you have to consider the observation. You can write this point. Okay, so now ICA has issued announcement dated amended para 17 of guidance note and state that while considering the observations of the component auditor in his report on the standalone, the parent auditor should comply with the requirement of SA 600. The same thing they told. You need to follow the principles of 600. That's why I removed this para 17 and all. Because they said whatever your SA 600 told, you have to follow. So tell that you have to comply with the principles of 600. Yeah, please update on this question. I may have to add one more element, that consider principles of SA 600. You can write that point also. Yes, sure. So with this, we are half done with this standard. So tomorrow we will complete it and we will do rest of the topic also. Yes, I hope you are very clear.